Hello, everyone, and welcome to the Cash Flow Connections Real Estate Podcast. I'm Tyler Lyons, and I'm very excited for the guest we have here today, who's a bit of a renaissance man in the world of real estate. He's done single family, he's done multifamily, he's done notes, he's done hard money, he's done syndications. You name it, he's probably done it. So I'm really excited to dive in this conversation here today. He's the CEO at OCG Properties, where they help their clients to attain financial freedom through providing support, education, and sound, positive cash flow real estate investment opportunities. Matt Owens, welcome to the show.
Thanks, man. Appreciate it. Glad to be here.
All right, really excited to dive in with you here today. So, with real estate entrepreneurs like you, I think it's helpful sometimes to understand your origin story and how you got into the world of real estate to begin with. If I'm not mistaken, you're a CPA by trade, so you didn't actually start in the world of real estate, but take us back to the beginning. What did you do initially, and how did you eventually get into the world of real estate?
Yeah, man, absolutely. And I think my story resonates with a lot of people just because a lot of people start out in corporate America and realize that that is just a horrible thing to do is in corporate America, is working in corporate America, dealing with the nuances and the bureaucracies and just the stupidness of the whole thing, right? And I was working at a CPA firm and doing tax and audit, and I actually went to UC Santa Barbara, got a degree in economics with an emphasis in accounting. Knew nothing about actual like accounting until I started working at a CPA firm and doing the actual work. I think my professional writing class was good in college, but that was about it, right? And I had a lot of fun at UC Santa Barbara, but coming to out of college, going into a CPA firm environment, it was very good to get that kind of knowledge base. And I actually worked on a lot of real estate clients and things like that. Didn't know what I wanted to do, but just kind of wanted to bang my head against a computer. It was just like, this is just horrible, like doing the most monotonous stuff over and over again, taxes and audit and stuff, and didn't know what to do. Took some real estate classes. And in 2006, I got my first deal under contract that I was going to fix and flip. And I could have sworn I was going to make 30 grand on that deal. I ended up making 20. And I quit my CPA firm job. I took some classes and, quit and was like, I just can't do this anymore. My mind was just gone on how do I make this other opportunity? How many flips do I got to do a year to make up my salary? I was making about 100 grand a year at the time and going, I don't have to do that many of these in order to actually like make my money back, right? And be free. And so I started doing that, and I quit in 2006. So I was a real estate genius for about a year and a half before I got my ass handed to me and punched in the face by the crash and, lost everything at that time. I ended up taking out, I had a 790 credit score. We had bought in a bunch of properties. I had a ton of empty credit card lines available to me, and everything was crashing and burning around us. And we were about to lose our own capital as well as some investor capital. And I took out 200 grand on my credit cards to make sure my investors were paid back. And, I took the hit for the investors and didn't realize at the time. I was just thinking, hey, I can't let them lose their money. Oh my God, this is horrible. And so I just took the hit for them. And after that, they started reinvesting with me and flipping with me consistently. And I started building up acquisition fees into these things to be able to keep the lights on myself, and then rehab management fees and things like that to basically build that in to the project cost. And I started doing multiple flips over and over again. I started doing 5 a month just because I was going, wow, I can make 5 grand a pop times 5 a month. That's 25 grand a month off of doing flips. Let's just go crazy at it, right? And of course, you learn every trial and tribulation along the way, even going forward, how to manage contractors. Still learning lessons on that, of course, and dealing with the tax and legal structures and how to raise money. And of course, as you do that much volume, the property management side of things, how to deal with human resources, how to do marketing and sales and everything else. You just learn how to run a business. And at that time, I thought I was dope because my books were done, and I'm a technician at this time on us as being a CPA, thinking, oh, my books are done. We were doing good as a company, and that's just the worst, way to think about things, right? It's just not the right tools, and you learn a lot along the way. But since then, we flipped over 1,000 houses now. We stopped needing capital sources from all our networking for our own deals. So I started lending out capital, and I actually learned debt and seller financing during 2008, 2012, when it was very difficult to sell houses. And so we started doing seller financing on our houses to people's IRAs, 401ks, 1031 exchange clients, and things like that, and being a little bit unique that way and doing that and creating debt structures to then go sell that debt off as well, and learning how to sell the debt off and how all the backup paperwork needs to go along the way for that debt side. So, you learn these different types of structures through your needs at the time, and you learn, I'll call it, how to stick and move, when things change in the market, right? So we started learning debt, and I started lending out debt when I didn't need the capital for our own deals. And so now we have over 35 million lent out to flippers in different markets around the country. We do lending nationwide on hard money loans as well as debt service coverage ratio loans. And then I started investing myself and doing different syndications myself for my own deals, and realizing and learning how to do the due diligence on those deals. And I really love syndications, honestly, because you don't have to do all the work yourself. You can diversify into different asset classes, different markets of the country, and different operators. You don't have to qualify for the debt yourself and things like that every single time, and do all that extra work that you have to do as an operator. So as you gain wealth, you can go put money passively into those and still keep your active operations going, where you can make, bigger chunks of money and things like that. So it's been a great ride along the way, I'll say, and it's been really cool. And now we even have a CFO services and bookkeeping company. I have a 6-month real estate course on every aspect of real estate investing you can think of, because that infrastructure piece of running a business and the different aspects that go into that is so important, on top of the syndications and the lending. And, I swear I'm never going to fix and flip another house again, though. It's just not worth the time. It takes so much brain damage managing contractors and a million teams in all these markets that it's just worth it to just focus a lot more on syndications and multifamilies and things like that, right? So the bang for your buck is a lot better.
Definitely, definitely. And like I said at the intro too, like a true renaissance man in the world of real estate. I mean, gosh, you've done so many things over the years and you've had success and made money in many different arenas. And I definitely want to get into the syndication side of things a bit more with you here today. Before we do, let's kind of back it up a little bit more back to 2008 when things really went sideways for you. We might be entering a time right now where a lot of real estate entrepreneurs are having a hard time. So I'd love to understand maybe a little bit more like what exactly did it look like for you when things went sideways in 2008? Were you like midstream on a bunch of flip projects and all of a sudden the value of the properties crashed? How did you kind of bounce back from that whole scenario? I'd love to hear just provide a little bit more color on that.
Yeah, absolutely. And during that time, we were buying properties, renovating them, and flipping them in like a few months every single time, like boom, 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 kicking them out. And we were selling them to our buyers that were buying them for rental properties, and being able to buy these properties from us across the board, right? And what was happening was, it was so easy back then to get financing at that time, right? In 2006, 2000, early 2007, it was super easy to get that financing. And then all of a sudden we went and bought about 35 houses, all cash, with different investor capital as well, that were partnering with us in different ways, or debt utilizing investor capital, and as well as some of our own capital. And right in the middle, when we were finishing those renovations, right in the middle of that, the lending market stopped. And so our only exit strategy was gone, right? We were going, oh no, what do we do? We took it to 6, 7, 8 different brokers, and those brokers thought they could do the deals too. And all of them were saying, oh yeah, we got you, we got you. But they didn't even realize that that was not possible, that the lending market was stopped completely. And, then there was no appraisals for a period of time, and, market prices were dropping. The only properties that you're seeing out there that are trading were cash properties and things like that at much lower market values. And so you couldn't get appraisals to save your life anywhere near market values. And so that was just, a big blow to us, where we were super cash poor because we went all in at 35 houses, with a bunch of our own capital and things like that. And we're cash poor at the time. Of course, I did everything wrong in the beginning too, on top of that, right? The operational efficiencies of our structures looking back were a big problem, right? Like, we got an office at the World Trade Trade Center in Long Beach on the 23rd floor, right? Like that was $5 grand a month. One of the stupid thing to do and starting off in business, right? I had two stepbrothers that were both my business partners. One was an electrical engineer, another one was a computer programmer, and I'm the CPA, and I'm supposed to be able to talk to people and be the one with personality, right? So and you realize we're supporting all three of us, and then a couple of other staff members and things like that, because we're trying to ramp up at the worst time without the right operational efficiencies across the board and the right business structures. Like I said, I thought I was dope because my books were done right, and we're starting to flip properties all of a sudden. And ego gets big because you're like, oh, I quit my CPA firm job, and we're flipping houses all of a sudden, not realizing that I didn't know shit at the beginning, at the end of the day. And really what I'm seeing, the similarities is a lot of when there's economic volatility, the people that don't, and the investors that don't have their operations really, really in tune, where they're running like a well-oiled machine, are the ones that are going to have those issues. The ones that don't know how to stick and move, the ones that don't know how to manage problems correctly, or have not seen those problems and what to do, and the different exit strategies that are available to them, are the ones that are going to have those types of issues. Or maybe they bought wrong in the beginning and they don't understand, alternative ways of moving assets or raising capital, and don't have the resources developed to be able to do this, because your resources are massively important, right? If you have tons of investor capital out there, you have tons of different contractors, managers, team members to help you rebuy new properties, and with better equity positions, stuff like that, to help you move out of a bad situation into a good situation. That's where you're going to have those types of issues. Now, I think the debt in this kind of a market is a lot better debt than it was in 2006 and 6, 7, and 8 that was happening right then. And now you're seeing people qualify a lot better. Their banks are a little bit more stringent. I think they learned some lessons from that last downturn, of course. And now they know how to work out deals. They know how to work out properties, right? When you had a massive amount of foreclosures and short sales and everything else that occurred there, now they know, okay, here's the procedure that occurs when this type of thing happens again, right? I think we're going to see a lot more volatility in the multifamily space and some of the commercial space moving forward, just because people bought wrong, and this time it's an interest rate issue. So those refinances are going to be a big problem moving forward for a lot of people in the multifamily space. And if they don't know how, or don't have the right capital sources to be able to help them bring in extra equity, or the resources themselves to put up that extra money upon refinance of their value add play, they're going to end up in a bad situation, because it doesn't cash flow as well as it did, right? The rates are higher now, so nobody wants to put in extra money for a lower return on investment than when they first started. So they're going to have a hard time raising that extra capital that needs to come to the table for them to get those refinances done. And we have a massive amount of refinances coming in the multifamily space this year and next year. So I think that's going to be a big value play that people can come in and make a lot of money on, but where there's going to be a lot of distress in the future. We'll see what the banks do, what kind of workouts they do. Those banks don't want those properties either, right? But at the same time, they may be taking some of those back.
A lot of great points there when you think about kind of coming back from 2008 and then going forward. Yeah, really getting processes dialed in, having your operations really buttoned up, then also
Mhm.
liquidity as well, right? Like for real estate entrepreneurs out there, we are in a position right now in the market where it is helpful to have some of that dry powder if things do go sideways or they do go wrong. You're hearing some horror stories around this variable rate debt that's out there as well. So yeah, some really good things to keep in mind for real estate entrepreneurs right now, given where we're at in the market cycle. And you kind of did single family, you did fix and flips, you did lending. Eventually, you did get into the world of syndication, right? And that's kind of you're putting a lot of focus on that nowadays. How did you find out about the world of syndication? How did you start to educate yourself on it? Maybe take us back to when you started to get into the world of syndication.
So back in, I think it was like 2012. I met a good friend of mine now named Jeremy Roll that a lot of people may know that he does a lot of syndication, specializes in the space, and he started vetting me and doing all different types of, due diligence on my company and things like that, where I started off with a fund where he taught me the different ins and outs of the financial modeling aspect of things and what to look for, the due diligence that needs to go into these things, how to actually develop, and the legalities behind the fund structures, because he's a full-time passive investor himself and had been doing it for years, and now is financially free off of syndications and things like that. And I started learning it there and started to do my own fund for a single family fix and flip fund that I had done, because I'm like, hey, I'm using all these individual single investors for all these projects, and it's starting to become a lot of work. How do I just put all these into one pile and learn this space? And so that was my first, kind of understanding and dive into the syndication space. And so I saw that structure and it seemed super interesting to me. And then over time, I started to learn ways of adding value to Jeremy as well as other investors out there, where I'm like, okay, you don't always have to do all the work yourself on these deals, right? You can find the operators and do the due diligence on them. You can find the deal and do the due diligence on that deal, where you don't necessarily have to do the back end operations. You don't necessarily have to raise all the capital yourself for those deals. There's resources that you can deploy and value add plays that you can deploy where not all the weight is on you. And so then I started investing in other people's syndications by bringing those to the table and doing the vetting and due diligence on those, and coming up with a 200-point due diligence checklist that I use now, where I basically go through and vet the operators in detail. I vet the deal in detail, the financial model in detail, the market in detail, all the legal documents in detail. So there's segments of this that you can actually detail out to do your homework on these. And it just made sense to me from a CPA standpoint to start that a lot more and bet on these different operators, instead of having to be the one where everything falls on my shoulders. Because you try to do too much, and which I learned the hard way, of course, and you start to become inefficient, right? You start to not be able to perform the way you think you should be performing across the board. And so utilizing other people to help you to diversify your portfolio into all these different asset classes, all these different markets of the country, and all these different operators has been massive, because there's so many benefits when you start looking at the syndication space, right? Not having to qualify for that debt alone, and you being only at risk for the money you put into that deal yourself is key. Being able to step back after that massive amount of due diligence you do up front, being able to step back and say, great, I'll review this stuff on a quarterly basis. I'll ask questions on a quarterly basis. I'll make sure I understand what's happening from an operational efficiency standpoint with those operators, but not having to do the work has been key. And when I had my kids, of course, I have a 7-year-old and a 4-year-old now. When I had my kids, I was immediately going, I'm drawn towards this lack of work type space, right? At least the operational work. And how do I add value by bringing capital sources to the table, by being able to add my own operational expertise to these people? How do I go through and help them with their own financial modeling and things like that, in different ways to be able to add that value to them? And so then it blew up from there and started expanding from there, where we've raised over $150 million now for real estate transactions, not just the syndication space, but overall with our lending and our fix and flip and our syndications. And so being able to have those resources to be able to deploy, and those investor relationships to be able to deploy, just made sense to start moving into this space in a much heavier, manner.
Yeah, that's really helpful. And I like the way that you think about, you explained adding value to different investors out there. The earlier that you understand that the world of real estate is a team sport, the further ahead you're going to be. I know for me personally, when I was earlier on in my career, I started doing deals on my own account, like many people do. I was buying single families and duplexes and fourplexes all on my own account, and I controlled everything myself. And kind of making that mindset shift to like realizing that real estate's a team sport, that's something that really accelerated my career, and it just opened up a whole world of opportunities for me personally. And now my outlook is way different than it would have been just a few years ago. So that's really great perspective there.
Right. And I think at the end of the day, looking at the different team members you're actually working with in the syndication space versus like single families and debt and that kind of space, you look at the lack of sophistication from a single family fix and flip investor. Now, there's some really sophisticated people out there that still do that business, but at the same time, there's a big lack of sophistication there in comparison to the syndication space, which is usually more institutional type money, higher level, capital raisers and capital providers and things like that, right? More strategic implementation plans and things like that versus the single family contractor. You're managing single family contractors, single family property managers, single family wholesalers, and fix and flip team members. It's a whole nother level of having to teach them and have proper quality control than coming into this syndication space, which usually people have a little bit more experience doing because they've already done some extra other stuff over here and said, wow, this is the more efficient play over here to be able to focus on these higher and better use things. And you get a higher level of that sophistication with the syndication space.
Yeah, it's a great point. I mean, if you're an investor, where do you want to play? Do you want to play in the space where the broker is making a couple few grand per transaction, or the one where they might be making six figures? Do you want to be
Right.
working with the property management company who's got an on-site person who's maybe making an $80,000 salary, or the company who's kind of bouncing around and managing little like one and two
Right.
unit properties? Right, it's a whole different game in the world of syndication, and once you get into it, there's a lot of benefit there for sure. And
Right.
in the world of syndication, so you've raised a lot of money that you like you alluded to earlier. One niche that you've broken into that I think is fascinating as well, and I'm really excited to dive into this with you here, is you've raised quite a bit of money from foreign investors. Walk us through how you identified that niche. Like, how did that come about? Did you just happen across a couple of foreign investors? But you've really been able to kind of expand your horizons in that area. Let us know how you found those foreign investors and what impact that's had on your business.
So it actually started off where I was doing presentations in my home in Redondo Beach, California, where I had 30 investors coming to my house to do a presentation on single family homes, where I was showing them some of the turnkey properties that I did. I had my chairs lined up in the living room and all kinds of stuff like that. So it was pretty interesting from, how you get started. And I actually met a husband and wife. The husband was a white guy, and the wife was a Japanese girl that had a ton of relationships in Japan specifically. And in that market, they were raising capital for their own flips and raising capital for other projects that they were doing from Japanese investors specifically because they just had good relationships there already. And so through them, I started learning the ins and outs of the how to deal with that from a kind of cultural perspective, what their needs were, what their interests were. I realized, hey, in Japan, you can write off a property over 5 years for Japanese tax law. So I started going from the CPA side of me and saying, okay, well, what are the tax treaties? What's the ins and outs from getting them set up here to start, right? How do they initially invest here and get set up to be able to invest here and actually do tax returns and do withholding taxes and all that stuff here? How do they actually do the ongoing maintenance of that with withholding taxes and everything else to learn that side? Because think about it, you investing in another country, right? What's the biggest thing as far as you not wanting to invest, or the risks in your mind? The risks are that, hey, one, the legalities, what are my rights in those countries, right? Also, who's the team that you're gonna rely on to do this workload? And how do I deal with the tax side and everything else? It's really the structure. The investment can stand on its own, but it's always the team and the investment on any transaction, but then it's always the legal legal structures, tax structures that are just eluding you, right? So I was able to dial that in really, really well with my CPA background, getting the right advisors in place. And, I paid the wrong advisors, of course, at first to teach me, how to do this, and pay them way too much money that I could have just gone directly to CPAs that already knew. But I'm like, here, attorney, you tell me all the tax treaties. Go do all this research for thousands of dollars that was pointless, right? So, and you learn the hard way that way, right? And then I started, in addition to understanding the infrastructure and being able to relate that directly, I started saying, okay, well, ongoing, you have to have translation services set up for them so they can get, their monthly management statements and problem resolution handled, so you don't have to be doing that all the time. I started doing presentations in Japan with translators and things like that. I started meeting these different investors, and then I started expanding my investor liaisons in these markets that are already marketing for investment purposes to Japanese investors and other international investors that I could work with, that basically are already involved in real estate but didn't know what they were sitting on. So I started really honing in on my focus on teaching these different investor liaisons, because they already have the relationships. And in order for them to feel comfortable enough to jump ship and from their own country into another country, they have to have that relationship, knowing, hey, we vetted this guy, that the liaison has already vetted me. They've already seen my processes and procedures, and I focused on teaching those liaisons those things so that they could teach their investors that they already had those relationships with. And then it started snowballing from there, where I had multiple liaisons in different countries helping me with these different aspects and raising capital from these different sources. And I was able to start off with single family homes or individual promissory notes versus syndications, to start developing the relationship with them, which enabled them, one, to show performance on the single family homes and show that we stand by our word. If something breaks on a property right away, we just handle it. I put aside money on every house that we sold just to do problem resolution that we all know comes up with real estate that occurs, right? I would go through and get them paid off on their promissory notes, just like they said should have been paid off, to show that performance over and over again. And then it started snowballing from there into more and more and more referrals that then would start off investing in these smaller asset classes, that then they started investing, after the relationship was built, into these larger syndication investments and raising larger amounts of money, and even some institutional capital out in Japan specifically. So, and some of these other markets as well. So, it starts off with the education of the liaisons and showing them and letting them do all the due diligence on you, and making sure you're really pounding the pavement with these different operators, or these different people that are already out there doing the relationship development, and then showing them that due diligence that they could do on you, and making sure they are 100% on board and confident in your abilities, that you're going to do exactly what you say you're going to do. And you always make them look amazing to their clients, right? Because then they will really stand by you forever if they know that you have high integrity, because that's the biggest key, is that integrity piece, right? Even when things go wrong, proper communication, proper integrity, take care of their clients and make them look amazing, and you will do really, really great with the international clientele.
And for your Japanese investors, how might their expectations of what they expect for returns and for an investment to perform, how might their expectations differ from those from the typical U.S. investor who are used to investing in private placements and seeing a 15% internal rate of return? How are the expectations different?
Yeah, so at the end of the day, when you're working with international investors, you're looking at what are their options out there, right? And many investors, you can get as low as 6%, 7% on their funds, and they're extremely happy with that. It's just like any new investor. When you're working with new investors, you start showing them 10, 15% plus returns, they're immediately going, "Huh, that sounds weird. That seems like a scam to me. That seems way too good." They might be used to CDs and and things like that, right? And so looking at it from that perspective and saying, okay, there are some professional investors that want higher level returns, right? And they're probably utilizing other private investors' capital, just like we do here with syndications, and making spreads on that money and interest rates on that money. So they need to make, higher level returns. And there is that base of clientele out there. But once the trust is built, I found the trust is 10 times more important than even the return in itself. Yeah, they want to have a good return on their money that they think is fair, but at the end of the day, it doesn't need to be these 10% plus cash on cash return type deals that you see in some cases, or even 8 necessarily. We've been able to raise it as low as 6 and sometimes in the 5s at the same time. What matters is that trust that's built, because they want to know that at the end of the day, you've got them covered. I still have investors that come back to me. We've sold over 500 individual single family homes to Japanese investors specifically. And even after they come to me and say, hey, I'm thinking about selling now, in this kind of a market, I help them with, my team helps them with an analysis. I take care of them. I help answer some questions to make sure they're taken care of. Most of my team does a lot of that stuff now, but at the end of the day, we always lead first with that customer service type attitude and say, how can I make sure you're taken care of? Oh, by the way, do you have additional referrals to help us? But that mitigation of the risk from that trust that they have a good team member on the ground in this other country that they're thousands and thousands of miles away from is the most important thing that you could provide to them.
And for the listeners of the program who are raising capital and would love to find opportunities to find foreign investors to invest in their deals, what's the best way, or do you have any recommendations on how investors might be able to find foreign investors? I know for you, you kind of found it through your own guerrilla marketing tactics and
Mhm.
inviting people over to your house and presenting to them directly. It all kind of just exploded from there. But do you have any
Right.
recommendations for people on how they may be able to find foreign investors?
So specifically seeking them out in these other countries. So you can do some research on finding other people that are already specializing in investments, international investments in those countries. So you can go to these countries or research them online where you're saying, okay, let me go find the specific people that are already developing these relationships, that are already helping people invest here in the US, and start developing those relationships in detail. Have a specific due diligence checklist that you can have them do on you. Provide them the background checks, provide them investor referrals for other people that have invested with you, provide them the details of the documents, do Zoom video meetings with them to teach them everything you can, add value. If you're providing content, say, hey, what if we go through and I'll develop specific content for you so that you can go then and take that information out to your clients and recreate it in your language to be able to do that, and even find ways of recreating your own content yourself into the other languages so that way you can do that. Like on my website, ocgproperties.com, we have Japanese, we have Chinese, we have Taiwanese, all different links on there, which will translate our whole site right into their language automatically. And so you're targeting those things so that making it easier for them to do that. So if you teach them, this is how you get set up, this is the structures that you can use ongoing and what to expect. Here's our website that's already developed in your language, already to go with this. Here's other referrals of other people we've done and worked with in that country. Or if you don't have that yet, other investors that have worked with us that you can do your due diligence on. Here's my background check. Here's my financial picture and my financial statements. A lot of the same thing that you might do with a higher level private investor here in the US, but you're having that dialed in and you're having it kind of custom built for them, where you can say, look, I have a translator already in place that'll charge this for reviewing your monthly management statements or your quarterly reports, that can translate these for your clients directly and have it teed up for them. You're basically trying to serve them up on a silver platter all the resources they need to make their life way easy, where you're customizing it for that language already, saying, what things can I do with my current systems to make it so much easier for these investor liaisons, so they're not having to go take all your marketing material and translate it into these different languages, right? They're not having to go through and put a translator in place or be the direct communication source all the time for them to answer every question, because they're not going to want to go through and have to deal with them long term on something when they get paid up front, or they get paid a fee for selling a house, or a fee on a promissory note or something like that. You don't want to go through and have to continuously pay them for that workload. Now, if they want to do that and be the direct source, great. They can even develop a fund-to-fund structure. Sometimes they're already set up to do that. But at the end of the day, going out and setting yourself up to be strategic for that specific market where you're making it easy for them is one of the biggest keys. And also understanding what their motivations are up front, right? Like in Japan, if they can write off a building over 5 years for Japanese tax law as far as depreciation goes, based on the entire full purchase price of that property, that is huge, right? That's a massive tax benefit. So you're going to market to those specific things, right? So we're going out telling them, hey, go buy a single family home from us, and you can go write this off. Here's your tax benefits across the board. Here's how it's set up here. Here's your translation services. Here's all the reporting that's already translated so you can see what you're getting every single month. Here's all the other people that have worked with us in all these other ways. So you're teeing it up like on a silver platter, making it super easy for them, and playing to the specific pain points and benefits for them and their market individually.
Yeah, that's terrific, man. That's super duper helpful. And you touched a bit on some of the operational quirks that are associated with raising money from foreign investors. I mean, whether it be just the significance of the relationship building that goes on, translation services, all those little elements. But what about the regulatory side? When you started to raise money from foreign investors, were there any significant regulatory hurdles that you had to overcome or that you had to understand or that investors should be aware of before they raise equity from foreign investors?
Absolutely. So there's two different types of regulations, one here in the US, right, as well as internationally in their market, right? So here in the US, obviously understanding the tax treaties, understanding what countries you can and cannot raise capital from or need to be very careful about that don't have tax treaties where you're doing max withholding, making sure you're being very, very careful about, the big no-nos, the terrorist lists and things like that that you got to be careful about, right? And then, so that side of things is absolutely key in the U.S. to make sure you understand the tax structures, the legal structures, even estate planning issues associated with international clients, so that way they don't run into a situation where they're investing individually here in the U.S. They pass away and there's a 50% tax above $60,000 in estate planning limit, right? There's different limits on these different laws for international clients versus clients here in the US, right? So knowing that side here in the US is absolutely key. And then internationally, right? Understanding basically what is the equivalent of the SEC in those other countries. We set up a Reg S fund to go, for example, in Japan to go raise capital, and realized after we were about to start deploying raising capital from them that we were starting to market the fund to our relationship bases out there. It wasn't out there marketed to the general public or anything like that, but one of the investors was a higher level investor and had asked the Japanese regulatory body about it, and they came and sent us a letter saying, hey, you can't do this, you have to jump through these 15 other hoops in order to do that here too. And we're here based in the US. They probably would have never been able to do anything to us, but we didn't want to go through and deal with having our investors have problems in that market specifically as well. So we just said, hey, we're gonna scratch this one. We're not going to move forward with that, I guess, filing and do it that way. We'll do individual deals instead of doing a syndication in that market and jumping through all those hoops, because there was some major regulatory issues like that you had to deal with to where it was just not feasible to go do that. The cost burden was going to be massively different than, it's not like a Reg D filing here in the US where you have a little bit of legal costs. It was thousands and thousands and thousands of dollars. It would have been like $100,000 with the legal costs to actually just get something set up there that just didn't make feasible sense if we were to move forward with that. So they didn't care because we hadn't raised capital yet from those investors. We were just telling them we didn't take any money yet, so we were fine on that side. And so we just said, hey, we're shutting down, don't worry about it, type of deal. And it worked out fine. But at the end of the day, we didn't realize that in the beginning. We're like, great, we're here governed in the US, and our attorneys here in the US are saying, well, you don't have to worry about that, you're governed here in the US. And of course the attorneys were wrong, because you still have to worry about it from your investor's standpoint, making sure your investors are taken care of. It's not just about you, right? So I was mad at that attorney for telling me that, of course. And he's like, I want to get the legal fees. Yeah, you're fine. So
Yeah, that's really helpful advice. And this has been a great conversation too, man. I've taken down so many golden nuggets. As we start to wind it down here, I've got one last question for you, and I assume this probably varies a bit from country to country. Everyone's going to have their own kind of specific nuances when it comes to culture, but when you think about the cultural differences between the U.S. and some of the countries where you've raised private capital from, what advice would you have for capital raisers out there to kind of navigate the cultural differences? Do you have any just kind of general words of advice on that?
yeah, absolutely. So, a lot of the different people uh, that are raising capital international, they may already understand these cultural differences, right? Myself, being a good old white boy from America, had no idea the Japanese cultural differences, for example. I had to be taught those things by my investor liaisons. Just one, little example is like, when you take a business card from, a Japanese client, you study the business card. You don't just take it and put it away. It's disrespectful, right? And that's just one little tiny thing, right? It's like a minor thing, but it could be huge if you didn't understand that right up from the front, right? Some of the other things are they take you very literally in some of these markets, right? If you go tell them, hey, this is the way it works, and it works any differently, then they're looking at you in a different way, saying, hey, you didn't perform the way you should have performed, versus, hey, that seems like common knowledge to you that sometimes things change, right? There's risks to investments. There's things that don't occur, right? If you go put on a financial projection that your projected repairs per unit are $200 a month per unit, and they're 300 per unit, then you didn't perform in their eyes, right? So you need to be able to very clearly explain some of these nuances. Say, these are financial projections. Let me go over every single expense projection, that this could vary sometimes. These are the risks that could occur. Document those things. Make sure it's super clear about the variances that could exist, because if they're not, many times they will take you very literally, even if, and they may not have the right knowledge base. Sometimes they may already know these things, but being very, very clear in what changes could occur it's really important, and making sure they know those things up front so that they're ready for it when those occur, right? So we had an instance where, one property was over budget by $600 for the entire year in repairs compared to what we thought it was going to be, or what our projections showed. And they were like, you said it was going to be this. And so at the end of the day, I just covered the $600, because I said, look, this is a misunderstanding. This can vary. Here's the rules. No problem. I understand. If you didn't understand that, I'm just going to take care of it for you to make sure you're happy with this. And they were floating on cloud nine after that. And they went and referred us 5 more people because of that. So, some of those specific understandings and details, and also understanding the differences in their investment strategies in their market versus the investments here, right? Like, for example, in Japan, there's rules with regard to when you have to rebuild a property, or if you just have to repair a property. If it's older than a certain age, you have to basically tear it down and rebuild it. Versus here in the US, you might just repair everything and take it down to the studs, or do whatever you're going to do to rehab it. So there's differences there that you need to understand the nuances and explain some of those differences. But I would say go get trained on these different cultural differences, what not to do, what to do in a business relationship in these areas before you start to raise capital if you don't know them. If you're already from that country, you already understand some of these nuances, then great, right? But being able to go through and understand those things, and you might be from those countries, but don't understand proper business etiquette, right? In that country in particular, because you grew up here in the US, even if you understand some of those nuances, you still may not understand how things have changed in that market, right? And, for example, sometimes discretion is very important because someone working at a corporate job, for example, in Japan, they don't want to go tell their employers that they have all these other investments that they're trying to do over here to improve their financial position, because they're supposed to be, the company man, the company woman, where they are focused on the company and that is their life, right? That is their 100% dedicated to that company. If their employer knows that they're out here trying to make themselves better over here, then in the employer's mind, they are not 100% dedicated to that position and that job. And so, understanding that discretion and making sure that they have that discretion is key, and that you respect those types of relationships is, really, really important to them, right? So you also have international issues when you're dealing with notaries and, going to U.S. embassies and stuff like that, when you're directly purchasing properties and directly investing in assets and getting releases done. That can be a massive headache, because sometimes those embassies, for example, might take a month to get an appointment or something, and that is a big deal when you're trying to close a property quickly, right? So planning ahead for those types of differences can be key, so you can get your paperwork done correctly and, are not stressing them out, because the more you stress an investor out, the more you make them do work, the less they're going to want to redeploy and reinvest with you.
That's excellent and a great point to end on, man. I really, really appreciate your time today. I think our investors are going to love this particular episode. If people want to follow you and what you've got going on at OCG Properties, Matt, what's the best way to do that?
You can email me at mpo@ocgproperties.com, or you can go follow me on YouTube, which the handle is at OCG Masters of Real Estate. So those are the two best places as well.
Awesome. Matt, again, thank you so much, man. Really, really appreciate it.
Thanks, man.
Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. Three of the key pillars to becoming a successful real estate investor. Number two, you can join us on our mailing list where you'll get tips and tricks on real estate investing directly to your inbox. And number three, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.